Hello fellow eToro traders and investors, Dan from Trading with Dan here. Happy Fed Day guys. Hope you are all safe out there in these markets. So yeah, just a quick look at my eToro. I just did a video on Bitcoin, an interesting moon pattern I spotted that I've seen in the Bitcoin chart. So take a look at that quick video if you get a sec. So yeah, so position wise, I've not really got any position on, still just holding on to these two. Um, but yeah, but now that the Fed decision has been done, I will look to take some more positions now. Now it's more safe in the markets. But yeah, so I'm still looking to get another 1 or 2% by the end of December. So, and then keep my risk down to 1 or 2. We will see how I get on with that. I mean, that is my aim here with this not this channel, this portfolio is to have average risk of 1 and a 1+ % return per month. Right, so over to the markets. Let's see what we've got going on. We will start first with oil. So yeah, as I've mentioned in my videos recently, I am bullish of oil. I think oil is gonna be going up now, just based on the fact I think inflation is going to be going up. Inflation is going to be increasing, so that will drive up the price of oil. You can see here on the daily chart we are in an upwards channel. I was saying that I would be looking for shorts around this level, but it is hard to short something that I do believe is ultimately going up, but there have been numerous good shorts. I was looking at it again today when we were sort of not really going anywhere, so it's like we need some impetus to push us higher, but I couldn't see that really coming around, and we did get a sell-off, but we instantly got bought back up again, practically near not far off where we were. So that just show the bullish nature of the oil market of crude. And yeah, so while we were potentially looking, I mean, if this dip had got down to like 55, 56, maybe even low 57s, and sort of flagged out there, I would have been looking for a long. But yeah, I mean, catching falling knives like this, I mean, it's not a way to trade with longevity, to say the least. So yeah, so moving over to gold. Um, Gold did have a spike up after after basically the interest rate decision. I had been looking for buys around the 60, 62, 64 level, but I did get in a bit too early on that trade. I think it was around here, so I scratched that trade. I was looking for another entry, but then, well, this was yesterday, and we were getting quite close to the actual rate decision day of today. So I don't like to take positions in the immediate future before, or hold over that. So I mean, as you can see, there was clear volatility. I mean, it would have obviously gone my way, but I always consider it a coin toss. But yeah, so gold. I mean, gold has been trading in a what I would describe as a sort of like either a falling wedge or a falling channel, which statistically breaks up more often than not if we are in an overall bull trend, which you could say that we are. And I would like to draw your attention to the similarities between this sort of bull flag we had here and this sort of bull flag we had here. We were like in a channeling down. When we broke out the channel, we then resolved to the upside. I am fully expecting exactly the same sort of price action to happen here, whether it break out from here, whether we go a bit low and break out from there. I know a lot of traders are looking, and a lot of investors are looking to get in at the 1440 level, so that could be front ran. That this could be as close as we got to it. 14, I mean, you got to say 1445 is very close, but I mean, we are still in this shorter term downward channel, so you could fully expect another leg down that could take us to 1440, potentially through 1440. But yeah, but as soon as, I mean, holding up here above 1470, 14 above 1470, I think this does open us up to 1490, 1500, and then potentially out the top of this descending channel, falling channel, and then beyond the highs, and then onwards and upwards. So that is how I'm looking to be playing gold. I mean, yeah, overall, yeah, like I have been saying in my previous videos, overall, I am very bullish of gold. I mean, I can't really see many scenarios that what is going on in the current world of finance, with the exponential fiat money printing, and the actual buying up of gold by high net worth individuals, central banks, yeah, so and just ordinary folk. So yeah, so I can see that there is going to be a lot of upward pressure in gold. I mean, there is a scenario I can foresee where gold will make a major correction, and that's if when we do eventually hit like an actual liquidity event or a recession, because what often happens is people will then have to liquidate their good assets that are performing well, to cover margins or to cover losses from assets that would not have done so well in those scenarios. So gold often gets sold because people just need the capital, they need the cash. So and then obviously that can start a cascade reaction. I mean, everyone might not need the cash, but some people might need the cash, so they might start selling. And then once they do start selling, that will encourage other people to think, well, I better take my profits now because we don't know how low this sell-off will go, and just exacerbate the sell-off. So that is just part of how markets are driven and function. So yeah, so over now to the Fed rate decision. Yep, as I said, happy Fed day. Fed rate decision, interest rates left unchanged. I mean, that was pretty much to be expected. There was no real way they could lower them again, and there is no real need for the Fed to lower rates at the moment, because I believe the drivers behind the three rapid Fed rate cuts were an inverted yield curve and a strengthening dollar, and the dollar is now well under the dollar index. The XY index and the trade weighted dollar index, which is potentially the more important one, the trade weighted dollar index, because that's more weighted with against emerging market currencies, were at very high highs, persistent highs, and they are now off their highs, and the yield curve is fully uninverted. It is uninverted now. So yeah, so there is no real reason for them to cut interest rates again. So yeah, it's interesting if you read through this article. Only a few points I noticed. Yeah, Fed rate interest rates left unchanged, and indicates no changes through 2020. So I'll just repeat that. Indicate to no changes through 2020. I mean, this is a Fed that was raising rates right up until the very end of last year, the very end of last year, 2018, after 4 rate raises that year, and the last one, which is the one that basically blew up the corporate bond market. Didn't blow the corporate bond market up, but there was no issuance of new issuance of junk debt. It basically those markets seized up, those bond markets seized up, and yes, and so then the Fed had to do its famous 180 pivot from hawkish to dovish, from running off the balance sheet to not running off the balance sheet, and then obviously got to where we've got now, which were massive 3 rate cuts and increasing the balance sheet. One thing first thing I wanted to point out was the number of rate changes we've had over the past few years. I would say we had all these, obviously the 2008 financial crisis, we had all these cuts, and we basically got to zero. So, I mean, you can bet if we were higher than 3.5% before January the 22nd, say we were at 5 or 6%, and there was more cuts left to make, would have had more cuts going into 2009, probably until they ran out of cuts in 2009. But my point is there would have been more cuts. I mean, we stopped cutting here because, I mean, I think at that point, negative rates weren't, well, I would say a pipe dream, but they weren't even a dream. They weren't even something people even considered. But yeah, but so negative rates weren't considered then. So zero was the zero bound. So yeah, so then 2015, our first increase. At the end of 2015, end of 2015, end of 2016, our second increase. I mean, you'll notice how these are in December, because this is when markets do tend to have a bit of a Christmas rally, and everyone's yeah, a bit happy. You can maybe sneak a rate increase in there without destroying the market, unlike 2018 when they couldn't sneak that rate increase in. But yeah, again, so March, June, December 2017, 2018, 4 rate increases, and then till we had the final one, and then till this year when we had to again do the famous PE Powell pivot, PE private equity Powell, his nickname, my nickname, his nickname for him, nickname from the fact he is formerly of the Carlyle Group private equity company, so PE Powell, private equity Powell. Anyway, yeah, so my point is we had rate cut, 3 rate cuts, 4 rate cuts, 3 rate cuts, but next year we're going to have no rate cuts. Yeah, okay, pull the other one, Jerome. It might jingle, especially this time of year. But it actually won't. I don't believe you. We'll. I mean, it's just. It's like walking a tightrope, because we do have the threat of inflation, and we do have the threat of recession, or both, stagflation, and a recession. So there are going to be forces that are going to be driving potentially lower rates, and forces that are going to be driving potentially higher rates, as in to fight inflation. And I don't see that one of those forces won't at any point be stronger than the other force that will then force a Fed rate move. I mean, basically what the Fed is saying is that it just doesn't know. So it's not going to say, oh, we're going to cut rates next year. It's not going to say we're going to raise rates next year. It's just going to have to wait to see which of the doomsday scenarios comes first. Yeah, but I mean, we do all know that, well, the committee judges that the current stance of monetary policy is appropriate to support sustained expansion of economic activity, strong labour market conditions, and inflation near the committee's symmetric 2% objective. So first, sustained economic expansion. I mean, if you just look at the PMIs, well, for the world and for America, we're not really in a sustained economic expansion. I mean, a strong labour market. I mean, we did have a strong non-farm payroll number, but I would say those numbers are heavily manipulated. Lots of things are left out of them to make them seem stronger. I mean, the market force participation number, so the amount of people that are actually in the market, in the job market, is low. Is low. So you wouldn't, well, on their statistics, you would call it a strong labour market. I guess on their statistics, they must have a sustained economic expansion, otherwise it wouldn't be saying it. And inflation measured by their statistics at a 2%, near a 2% objective, which isn't really the case. But yeah, and then there was one thing else I was reading here about the dot plot, the Fed's dot plot, which is pretty much always wrong. So yeah, so here we go. Here was a dot plot. Dot plot shows no 2020 hike. But yeah, incidentally, this Fed's dot plot has never been more divergent from, has never been further from the actual plot, the dots plotted by the Fed's fund futures market, which is where the actual market predicts the rates would be. So there you go. Yeah, and an interesting fact on the inflation, interesting point on inflation is that inflation is clearly underreported for various reasons. I mean, I could do a video on how the inflation, CPI inflation is is not correctly calculated, and then also the CPI inflation number goes in as a core deflator into the GDP number. So it would be GDP would be a lot lower if we had a lot higher inflation number input into it. So it would be interesting to know going backwards how many recessions we would have had in the past based on a real GDP number and not one that has a lower than the real level of inflation input figure into it. But so they're my thoughts on this. Yeah, happy trading, guys. And I will be back with another video tomorrow. So yeah, thanks for listening, guys. Have a great day.